Now, of course, the key term, of course, increase or reduce. So did this report make it more likely that Ben Bernanke and company will back off stimulus? With us to talk about this, CNBC contributors Dambisa Moyo and Greg Ip, and our own Steve Liesman. Dambisa, welcome.
Hi, thank you.
Nice to see you again. What do you think? I mean, is this the kind of report that if we keep having these kinds of reports, it's more likely the Fed pulls back sooner rather than later?
So I think this is neither fish nor fowl in the sense that the headline number looks good. I don't think this takes away at all from the fact that we're looking at a 1.5% to 2% GDP number for the United States. For me, there are a couple of things that are bothersome. Rather, in fact, specifically 4 things. First of all, hours worked. And I know we've been talking about this the whole day, so I won't go into grave detail. Hours worked, still an issue. The U6 unemployment number, also still an issue. Diffusion number in manufacturing, still lots of concerns, decline there. And finally, the quality of jobs that we're creating. So in that regard, I do not think that we're going to see any change from the Fed.
So you don't see them pulling back or
Absolutely not. I mean, I think the number we should all be focusing on here is participation rate and not the headline unemployment number, which I think could be very misleading for a policy stance.
Steve Liesman, what about you? Does anything in this jobs report push you one way or the other relative to what we heard from Bernanke this week? That one quote, reduce or increase.
Yeah, I mean, I think if we continue on this trend, Maria, it does marginally reduce the amount of time. You know, Maria, I was trying to think of the equation for the question that we were going to talk about today. And here's what it is. Delta of unemployment, call that X, equals some unknowable amount of QE over some unknowable time. Notice there's 3 variables there. The change in unemployment equals some unknown amount. If you ask me, I'd say, you know what? It probably foreshortens the amount of time that the Fed is going to be out there buying QE and the amount of QE it buys. But it may be like weeks, and it could be like tens of billions of dollars with a base of trillions. So not a lot, Maria. If it continues, yeah, then I'll change my forecast.
Greg, do you think this is the kind of a report that maybe the Fed was thinking about when they released their statement the other day about adding or subtracting, pulling back or increasing? Don't get too excited about 1 or 2 or 3 different reports. Is that what they're after here?
I think that you had a situation where a month ago, most people at the Fed thought if the labor market continued to improve at the pace we had seen in January and February, they would have stopped QE or dialed it back significantly by the end of the year. The bad numbers in March forced them to rethink, and that is why they changed the statement on Wednesday to flag the possibility that if the economy tanked, they could actually increase QE. What today's number does is I think it takes that possibility off the table. We are not going to hear any talk, I don't think, in the Fed for a while about dialing up QE. However, it doesn't quite get to the level that says they're going to dial it back. They've said they want to see consistent job gains, I think around 200,000 a month. We're not quite there yet. And they want to see the unemployment rate going down for reasons other than people dropping out of the labor market. In April, it was pretty good. We had people coming into the labor market, but we haven't seen that on a consistent basis. So good, but not sufficient for the Fed to dial back QE yet.
Dambisa, what about Europe? I mean, how much of an issue is Europe, and do you think we're going to see more of an impact of that weakness on the U.S. economy?
So first of all, finally, they seem to be getting it. I think the rate cut yesterday was exactly what the market was looking for, but also I think policy finally seeing a serious shift. And also, obviously, Mario Draghi's comments around negative rates, the possibility of thinking in that regard, I think is very positive for the story. I do still worry about the structural issues. Look at the unemployment rate from Spain just a few weeks ago, still trending in the wrong direction. I think that we can't get caught up with the more tactical market moves, which are showing significant improvements in yields in Italy and Spain and so on. We really have to focus on the structural numbers. I do think the knock-on effects for the United States are still things that we should be worried about in terms of trade and capital flows.
I'm just wondering how you say that this shows they got it. I think what they got was the problem 6 months ago. Wasn't it clear that European growth was going negative, that inflation was going to top off and probably trend down? And here they are cutting rates and people giving them plaudits for doing what they should have done 6 months ago if they were in a forward-looking regime. They've yet to take an action that shows me they get it.
Oh, well, I think there's much more that they need to do. I think it's pretty clear. In fact, when I was here last time, I said that I thought they were absolutely behind the curve. If you compare the actions of the Europeans with what's happening in Japan and what's happening in the United States and elsewhere, it just seems to me that they've been behind the curve. But I think my point is that finally they seem to be catching up with where the market and where other policy discussions are around the world.
And Greg, go ahead.
Yeah, let me just make a point about Europe. So I agree with both Steve and Dambisa that they have been behind the curve, but there were three interesting takeaways, I think, from Draghi's press conference yesterday. He talked about the possibility of negative interest rates. He talked about maintaining the low refi rate for at least a year, kind of forward guidance that we've not had from the ECB in the past. And he said that they are now negotiating a plan to directly extend credit to small and medium-sized enterprises. I would never call any of those three things a game changer, but the confluence of all three, the fact that they're talking about those things, I think is encouraging.
Greg, if they do them without being forced to do it by some market crisis, then I'd agree they're somewhere near being on the curve. But just talking about them, except for the forward guidance one, which is an actual policy thing. But if they do those other things before being forced, then I would agree with what Dambisa said, is they get it.
Yeah, but Steve, you have to talk about it before you do it.
Very quickly, both the Fed and the ECB took a swing at fiscal policies. Mario Draghi said they need to cut taxes, not raise them. And Ben Bernanke said fiscal policy in this country has been a drag on the U.S. economy, not helping. Do you think, as long as they're talking about sequesters and spending cuts, Greg, that they're more likely to spend more time on QA than anything else? Does that prolong the period when we have quantitative easing?
Absolutely. The Fed's view is that the main reason we're trundling along at 2% instead of 3% is because of all that austerity that's in the pipeline right now. I think that they would be optimistic that we'll have got through most of it by the second half of the year. But absent that austerity, we would have been growing around 3% now, and that maybe QE would have been tapered off already.
Yeah, you said it. I mean, may I just also point out that remember that the non-farm payroll numbers we got today is below the 6-month moving average, and it's below the 12-month moving average. There's still a lot of concern. I think it was particularly interesting that Bernanke mentioned fiscal policy in his discussion.
It's interesting. You guys are not believers. I mean, we've got some triple-digit move in the jobs numbers, and not a lot of believers.
They're not in this market.
It's supported by liquidity, and I don't think anything has changed in that regard.
All right, we'll leave it there. Thanks, everybody.
Thanks, folks.